Hello and welcome to this webinar, an IFRS overview with me, Peter Thatcher. The aim of this webinar is to provide an overview of the authority and application of International Financial Reporting Standards, IFRS, of International Accounting Standards, IAS, and interpretations. I will also have a look at the standard setting process of the International Accounting Standards Board as well. So in essence, what we're doing is we're providing a background to the world of international financial reporting. Now, for those of you unfamiliar with international financial reporting, what you'll soon appreciate is that we use a lot of acronyms, we use a lot of letters to replace words. I've done that already. So IFRS rather than International Financial Reporting Standards, IAS instead of International Accounting Standards, IASB for the International Accounting Standards Board, and so it goes on. Don't worry, during the course of this hour, I'll introduce a number of those acronyms and I'll explain them all so that hopefully by the end of the hour, you'll be as well versed as the rest of us in them. So what's on the agenda for this hour? Well, what I'm going to try and do in this hour is to answer these 6 questions. So what does complying with IFRS actually mean? The term IFRS is used in different ways, so we need to understand the context in which it's been used. Who uses IFRS? Which countries require IFRS to be used? Which countries permit it? And it varies quite extensively from country to country. So we'll just be giving a flavour of that and introduce a couple of particular countries to explain how they've used it. Who's involved in the standard setting process? What are the different bodies that you may hear about? How do they interrelate? And actually, what is the process that the International Accounting Standards Board goes through to set a standard? We'll have an overview of what standards are currently in issue, particularly with a focus on those that companies with reporting dates of 31st December 2018 will be using. And then we'll have a brief look at IASB's plans for future standards, what's coming up, and I think importantly, where you can find out more. We'll highlight a few websites for you where you can find out a lot more than I'll be able to talk about in this session. If you have any questions, please do feel free to ask them as we go along using your console. I'll try and answer them as we go along, but if not, I'll pick some up at the end. And hopefully we'll manage to get through all of those in the time that we've got allotted. So the first question, what does complying with IFRS actually mean? Now, IFRS is used with a very narrow, specific meaning, but it also has a wider, more general meaning. So, in a very narrow, specific way, IFRS refers to specific standards. We have IFRS 1, 2, 3, all the way through to IFRS 17. In its wider, more general sense, it refers to the basis of preparation. So it will refer to not only IFRS, but it'll also refer to IAS and also interpretations. And we'll come on to a very specific definition that's provided in international standards, which cover that. Now, just to confuse the issue a little bit, what you might hear people talking about, and you might see references to it in written documentation, is compliance with international accounting standards. Now, when people talk about compliance with international accounting standards, they are using the term international accounting standards in a wider, more general sense. They're referring to it in the same context as basis of preparation. It's not technically correct to do that. It's just historic. It's the sort of things that people like me are familiar with, and therefore we use that term. So we sort of accept that we use the term IFRS and IAS in their wider senses as interchangeable terms, but technically we should be talking about compliance with IFRS. And the reason why this is an important question to answer and to understand is that IAS 1, which is the standard which deals with the preparation of financial statements, specifically requires entities to disclose the fact that they have complied with IFRS if that is indeed their basis of preparation. So this is a standard basis of preparation note that you'll be familiar with under any sort of national accounting standard requirement. Now, where it says there to make an explicit and unreserved statement of compliance, what that means is that the entity would have to comply with all applicable requirements that are relevant to it. You're not allowed to exclude anything because it wasn't appropriate for you to do that. Now, where that can cause a problem would be, for example, if you had a jurisdiction's national law which was in conflict with IFRS. So if, for example, you had a national law that didn't allow financial instruments to be included at fair value, and a company had to comply with that national law, then it would be in conflict with IFRS, and therefore that company shouldn't make a statement that the financial statements have been prepared in accordance with IFRS. That's what it means by explicit and unreserved statement. However, it's not always as straightforward as that. That's the theory behind it. But what you will know or notice is you'll sometimes see sets of accounts that are being prepared in certain jurisdictions, the European Union being one, where they will refer to the basis of preparation as adopting IFRS as adopted by the EU. So not exactly an explicit and unreserved statement, because they're putting as adopted by the EU. Or if, for example, you're looking at a bank in Kuwait, that would refer to as adopted by the state of Kuwait. So there are exceptions to this blanket phrase of using IFRS, which just makes it a little bit messy in terms of what we're trying to achieve. But what is also important in IAS1 is it defines IFRS. Now, this is defining IFRS in its wide sense. So it defines IFRS as including international financial reporting standards, international accounting standards, IFRS interpretations, and SIC interpretations. So when we say a set of accounts has been prepared in compliance with IFRS, it means that they have complied with all of the relevant requirements of all of those elements. Now, we'll talk a little bit later about why we have international accounting standards and why we have international financial reporting standards. Just want to mention at this stage interpretations. We have a webinar coming up in March to do more on interpretations, but just to explain why we have IFRS interpretations and SIC interpretations, it's all to do with the body that actually issued them. So IFRS interpretations are issued by the current body, that's the IFRS Interpretations Committee. SIC interpretations were issued by the previous body, which was the Standing Interpretations Committee. It doesn't actually matter, it's just a badge that's attached to them. They are all equally important and equally valid. So the second question is, who uses IFRS? The International Accounting Standards Board does not dictate who uses international accounting standards or international financial reporting standards. There I go using the different terms as I mentioned earlier. The IASB sets the standards. It is up to individual countries, individual jurisdictions to decide whether they want to use them and which entities will be required or will be allowed to use them. If we just step back a little bit, the stated aim of the International Accounting Standards Board is that this is actually stated in the front of the Blue Book, which is the book that contains all of the standards and interpretations of the International Accounting Standards Board. And as you can see there, it's to develop a single set of high quality global accounting standards and require transparent and comparable information. Why is it important? Well, of course, nowadays trade is international. Companies diversify operations, companies raise capital in different countries. investors look for opportunities in different countries. And if you go back a number of years in particular, where you'd got individual countries with their own individual national accounting standards, that was making it difficult for preparers of companies with entities in different countries in the world to actually prepare the different sets of accounting standards. It was expensive, it was complex, and it also made it difficult for investors and users of accounts because they were having to interpret information under different accounting bases. So it wasn't a very efficient system. And it was also, we had situations where you could even get different results being reported by companies depending which set of accounts. In extreme cases, you might have a set of accounts prepared in one jurisdiction which gave a profit, and if you prepared them in a different jurisdiction, you'd actually end up with a loss. Frankly, a nonsense, because how could anybody interpret the real performance of the business in those circumstances? So there was definitely a need for global accounting standards to eradicate some of those problems. The IFRS Foundation states in its mission, it states publicly that there are three principal benefits of using IFRS to the global economy: transparency, accountability, and efficiency. Now, transparency is delivered by the quality of IFRS to make it clear what has actually happened within the business. But it's also achieved by comparability. If everybody uses the same bases, then performance becomes much more transparent. And it's an interesting concept because transparency has been a driving force which has underpinned many new accounting standards that have been issued by the IASB in terms of particularly of disclosures. Most new standards that have been issued over the last few years have increased the level of disclosures, and the IASB's justification has been that that's to give greater clarity about what's going on, so everything is much more transparent. And for some companies who are new to the world of international reporting, that can sometimes be difficult because international standards do not allow companies not to disclose information because, for example, it's confidential. The only driving force is transparency. It's about put the information out there and let users make their own decisions. And that's caused a bit of an issue for preparers, disclosing information they might not want to do, but also the general increase in the level of disclosures has added the burden onto preparers. The second benefit of accountability is essentially driven by IFRS providing information which enables management to be held to account, and also regulators, financial service regulators in particular, make particular use of IFRS. It helps them do their job too. And in terms of efficiency, it's about economic efficiency. It's about the efficiency to preparers of financial statements of the multinational companies, that they don't have to use different accounting rules in different countries. They can use one set of rules. So preparation of accounts is much easier. But it's also the efficiency for investors to be able to make their decisions on where to put their capital, therefore hopefully making it cheaper to provide capital to companies as well. So there are problems that IFRS will hopefully solve, and there are great benefits from having this global set of standards. But if we come back to the question, who uses IFRS? On the IFRS Foundation website, it's noted that at the moment 126 jurisdictions or countries require IFRS to be used by all or most publicly listed companies in that particular jurisdiction. There are other jurisdictions which permit the use, they don't require it as such, so it's extensively used. Now, of those 126 jurisdictions, more than half also require IFRS to be used by some of their very large non-listed companies, particularly financial institutions. And the majority of those jurisdictions also permit IFRS to be used by other companies, by non-listed companies as well. Now, understanding what the particular situation is for each individual country is therefore quite difficult. And so what is a really useful resource on the IFRS Foundation website are some profiles. They've got profiles of 150 jurisdictions. So you can go onto that section of the website and you can click on the flag and it'll take you to some analysis of what that jurisdiction's doing with regard to IFRS. So in particular, it highlights their commitment to global financial reporting. So of the 150 jurisdictions they've looked at so far, 140 of them have made a public commitment to global financial reporting standards. And in fact, even those that haven't made a commitment to global financial reporting standards, in some cases still allow IFRS to be used. So Switzerland would be an example of such a country. And what's very useful is it also covers the extent of IFRS application in that jurisdiction. Now, you might think that it would be very straightforward that if a country adopts IFRS, then they adopt IFRS. But countries adopt IFRS in many different ways, and so you need to sort of delve a little bit deeper if you like to understand that. So, for example, there are some countries who require IFRS to be used. So, for example, South Africa. South Africa requires IFRS to be used, or if a country is of a certain type, then they require the IFRS for small and medium-sized entities to be used. So they require IFRS in some way to be used by all companies. Most jurisdictions, most countries fall into, if you like, the second category, where they require IFRS to be used by some entities and permit it for others. So an example might be Brazil. Brazil require IFRS to be used for publicly listed companies and some financial institutions, the large financial institutions, and permit IFRS to be used for others. Some countries simply permit IFRS to be used as one of the accounting frameworks. So, for example, Japan. Japan allows IFRS to be used, but in the same way, it also allows Japanese GAAP or US GAAP to be used. Some countries have gone about it a different way, whereby they have actually incorporated the content of IFRS into their domestic standards. So Australia and New Zealand, for example. So their national standards essentially are the same as international standards. They've adopted almost word for word the international standard. And there are other countries who've gone for a slight variation on that, which is a convergence approach. So what they've done is they've worked, as they work on their standards, they are recognizing what international standards say, and they are trying to bring them ever closer by a process of ongoing development. And that's applicable, for example, for China and for India. So as you can see, the way that countries and jurisdictions have embraced IFRS does actually vary quite significantly, and it's ongoing. Just for a little bit of extra interest, I'll have a look at a couple of specific jurisdictions, see what they're doing with regards to IFRS. So the European Union is a specific jurisdiction. The situation in the European Union is that since 2005, IFRS, as adopted by the EU, I'll come back to that, are required for the consolidated financial statements of all European companies whose debt or equity securities trade in a regulated market. The regulated market is as defined by the EU. So, for example, in the UK, that would be the London Stock Exchange main market. Now, it's just for the consolidated financial statements. That's required by the EU. But the EU then allows individual member states to require or permit IFRS in other cases. So, for example, they may require or permit IFRS to be used on small securities exchanges that are not deemed regulated markets. So in the UK, we have the alternative investment market. It's not a regulated market, but it is a security exchange. And since 2007, companies who are listed on the alternative investment market are required to prepare their consolidated financial statements under IFRS. The EU regulation only applies to consolidated financial statements, but the EU allows member states to require or allow the separate financial statements of companies to prepare their accounts under IFRS as well. So this would be, for example, the consolidated financial statements prepared for a listed company under IFRS, and the parent company of that group could also prepare its accounts under IFRS or not, as the case may be. And then the final one is the EU allows member states to allow anybody or require anybody, any company, whether traded on a regulated market or not, to prepare their accounts under IFRS. So countries within Europe have different approaches as to who in fact is using and required or allowed to use IFRS. Whenever run sessions on IFRS and doing this sort of background to IFRS, it's a very common question for people to say, well, what do the United States do? I think it's true to say that the International Accounting Standards Board would really like the United States to adopt IFRS, because that would really give a greater momentum to worldwide adoption. Over the years, there have been many conversations and many statements coming out of the US which have given hope that actually that will happen. In 2010, the Security and Exchange Commission, the US SEC, made a statement which was a commitment to a single set of global accounting standards and a belief that IFRS was best placed to achieve that. But despite that public statement, and hope that we were going to get there, we've never actually reached that point where the US has been prepared to adopt IFRS. So what instead is happening with the US is there's a convergence program going on, and this dates back to 2002, where the International Accounting Standards Board and the American Standards Board, the Financial Accounting Standards Board, FASB, agreed to work together on a convergence program, whether that was IFRS being amended if the US version of the standard was better, or US GAAP being amended if the IFRS version was better, or as a new standard was being developed, is to work on it together. And we've seen a number of instances in recent times where the ISB and FASB have been working together on developing standards. So, for example, IFRS 9, IFRS 15, IFRS 16 are examples of essentially joint projects. And the influence of the Financial Accounting Standards Board, the US Financial Accounting Standards Board, on the International Accounting Standards Board is evidenced by the fact that FASB actually have representation on the International Accounting Standards Board. The actual position in the US, as it says there, is US companies whose shares are traded in the public market are not permitted to use IFRS. So they've not adopted IFRS, they have to use US GAAP. Other US companies may, in certain circumstances, use IFRS. And that's because companies which are not under the control, if you like, of the SEC do not have a determining accounting framework. They don't have to use US GAAP. So they could potentially use IFRS. Now, they probably would use US GAAP in most cases. It may be required by lenders, for example, to do that. But if, for example, you had a European company using IFRS, wanted to use it throughout the group, and it had a US subsidiary, then it may actually want the US subsidiary to use IFRS as well for efficiency of reporting. And that would be perfectly okay, providing the US subsidiary was not traded in a public market. For foreign companies whose shares are traded in the public market, they are allowed to use IFRS. So this would be, for example, if you had a UK company with a dual listing, listed in the UK, listed in the US, using IFRS for its UK account, it would be allowed to use IFRS in the US as well. So if we move on to think now about who's involved in the standard setting process, what are the main bodies that you might come across. The structure looks like that broadly. It's a three-tier structure with a monitoring board at the top. They oversee the trustees and approve their appointment. The IFRS Foundation below them, they're accountable to the monitoring board, where there's 22 trustees or a maximum of 22 trustees, and they provide governance and oversight of the International Accounting Standards Board. The International Accounting Standards Board is the standard setter, and alongside them we have the IFRS Interpretations Committee that I mentioned a short while ago. Let me work upwards, if you like. The IASB, the International Accounting Standards Board, is the one that you'll meet most often, probably the one that you're most interested in. 14 members from a diverse background, from different geographical regions. So, for example, there's 4 members from Europe, there's 4 from the Americas, from North and South America, Australia is represented, South Africa, and Asia. There's a staff team of technical people working behind them, but the ISB itself, these 14 people, are responsible ultimately for the approval of standards, the approval of exposure drafts, and the approval of interpretations. So they're the standard setting body. Supporting them is the IFRS Interpretations Committee. Now, again, just a little bit about them because we'll cover more on the webinar on interpretations in a month or so's time. 14 voting members and a non-voting chairman. They support the ISB in application of standards. So they respond to questions about how a standard might apply to a specific circumstance. In some cases, they would issue guidance on that application, and that might be in the form of an interpretation. And an interpretation does exactly what it says. It interprets a standard to a specific situation. It's not a new standard, it's an interpretation of a standard. So, for example, there's an interpretation on the treatment of website costs, which is an interpretation of standards on intangible assets, on tangible assets, and so on. So they support the ISB. So that's where the standards come from and the interpretations come from. The IFRS Foundation, 2 primary responsibilities. They appoint the ISB and the Interpretations Committee and the other bodies, and they also secure funding for the whole process that we have in place. In terms of governance and oversight, that's done by making sure that the ISB follow the Constitution, and importantly, when they're developing standards, they follow the due process handbook, which is a weighty document that, again, anybody can access if you're interested on what that says. And then above them, you've got the monitoring board. These are representatives from capital market authorities. So there's representatives from the European Commission, from the US Securities and Exchange Commission, from the organizations of securities commissions, IOSCO, and their role is to ensure public accountability. So they appoint the trustees of the IFRS Foundation and ensure they're discharging their duties, again, in accordance with the Constitution. Other bodies that exist, we have the IFRS Advisory Council. They provide advice and counsel to the ISB and the Foundation trustees. They act essentially as a bit of a sounding board, particularly on issues like what items should be on the agenda, what should form the priorities, and they might also be involved in major standard setting projects. They only meet 2 or 3 times a year, but they're acting almost like a non-executive director in a company, whereby they're bringing wisdom, they bring a range of expertise. You have preparers, users, analysts, auditors, regulators represented on this council. The next body referring to there is the Accounting Standards Advisory Forum. These are much more technically based, so they're supporting the Foundation in trying to make sure that we have high quality global standards, and so they would embrace technical discussions on standard setting issues to make sure that the right issues are being drawn out. We have a number of standing consultative groups. These are groups that exist on an ongoing basis, representing various interested parties. So, for example, we have groups which would represent the interests of preparers, groups that would represent the interests of users, groups that represent the interests of small and medium-sized entities. And then we have a relatively new set of groups, what are called transition resource groups. These groups are set up specifically when some new standards are issued to help the process of transitioning from old standards into new standards. So what these groups would do is they would seek to find out issues from interested stakeholders as they start to go through the process of transitioning to the new requirements. They would analyze and discuss those issues, and then they would give feedback to the International Accounting Standards Board. And that would form the basis of whether the IASB felt the need to actually issue some new guidance or some revised guidance, as the case may be. So we have resource groups for IFRS 15 on revenue recognition, on IFRS 9 with impairment of financial assets, and on IFRS 17 on insurance contracts. And a particularly interesting one is the resource group on IFRS 15, because as a result of the issues that the transition resource group picked up and fed back to the IASB, the IASB actually reissued IFRS 15 with some amendments into it to deal with those particular issues that have been addressed. So it really does work, it really does support the IASB to make sure that it's as smooth a process as possible. So how are standards actually set? And this process of going through is how a standard's set, but it also would include when standards are amended as well. Every 5 years, the IASB conducts a comprehensive review and consultation. It is an extensive consultation which defines the standard setting priorities, and from this consultation, they develop a work plan. The most recent agenda consultation began in 2015, it finished in 2016, and that has set in place the work plan from 2017 through to 2021. So it's a fairly extensive process to make sure the IASB is focusing on the appropriate topics. Now, it's not that entirely prescriptive, because topics might be added to the work plan between those consultations. That might be, for example, in response to a review of a standard which takes place, which identifies a need to update a standard, or it might be based on advice from the Interpretations Committee. But basically, the agenda consultation is an important part of that process. Now, typically, a standard setting process will begin with research. So the IASB will consider the issues, how significant they are, what's the problem. They'll identify possible solutions, think about how the conceptual framework might help, what other national standard setting bodies have got as a solution. And then what they might do, likely to do, is to prepare a discussion document. And that will be presented for public comment. Anybody can comment. One of the key principles of standard setting is full and fair consultation. And that's done by opening out these documents for anybody to express a view. So when they've got the views back, they'll consider the comments, and then from those comments, they'll decide whether to progress to developing a new standard. Doesn't always happen, identified is not always necessary. Basically, it'll move to developing a new standard if there are significant enough issues and there are practical solutions that could be developed. So what the IASB then does is it moves into developing an exposure draft. So the technical staff will develop an exposure draft, and when that's issued, that will reflect what the final standard is expected to look like. That's likely to include things like dissenting opinions of ISB members, those who don't agree with the approach that's adopted. Another of the underlying principles of the standard setting process is transparency. So it's important that people understand what the ISB's true view is of these new exposure drafts, this new guidance. And it might also include basis for conclusion as well, which gives a framework for why the ISB have concluded what they've concluded. After an appropriate consultation period, the ISB will then reflect on the comments. They'll form the basis of the ISB meetings. ISB meetings are open to the public, and potentially that'll move on to holding public hearings. There'll be extensive consultation with a wide group of stakeholders. Field tests might be carried out to actually see how it works in practice, to see if it works as the ISB think it should do. And following all the consultation, all the public hearings, all the field test results, the ISB may then decide to just amend the exposure draft and then issue it as a standard. We've had a few examples actually recently where the results of that process were such that the ISB actually reissued an exposure draft. There was a second exposure draft came out. Again, an example of that was IFRS 15. But when they've done those amendments, they're happy with the exposure draft, that it's acceptable to the vast majority of people, then we'll actually get the standard being issued or amendment to a standard being issued. For a standard to be issued, it only requires approval by 9 members of the International Accounting Standards Board. That's 9 of the 14. If for any reason there weren't 14 members, then approval is only required by 8 of those members. The standard will specify an effective date. That effective date is always far enough in advance to give preparers enough time to get ready to apply that standard, and also for jurisdictions to actually authorize its use. It may well be fairly short term. 18 months is typically the minimum time they'd allow, but it may be much longer than that. So IFRS 16 on leases was issued in January 16. It has an effective date of 1st of January 2019. The insurance standard IFRS 17 was issued in May 2017. It's got an effective date of 2021 because it's felt it needs that long to allow the insurers to actually apply the rules. And when the standard is issued, it's also accompanied by the basis for conclusions and an impact analysis and the details of any dissenting opinions. At that stage, it's sort of too late for that to impact on any interpretation. We have to apply the standard. It's more for interest and transparency that that information is made publicly available. So that's the standard setting process and who does what. Just to give you a sense of what standards are out there and which, if you like, are the most important ones, the exciting ones, if you like, that you might want to look at. So I'm going to spend some time just quickly highlighting some of the key standards that are in issue. And I'm doing this with regards to thinking about, for an entity with a reporting date of 31st of December 2018, those entities would have to comply with the requirements of 26 IAS, 15 IFRS, and 22 interpretations. Quite a lot of rules to actually apply. Now, it's mentioned on there, the IFRS for SMEs. Just do this very briefly. Again, there's a webinar coming up, I think, in April, which looks specifically at the IFRS for SMEs. The IFRS for SMEs, for small and medium-sized entities, is a standalone standard for small and medium-sized entities. It reflects the requirements of full standards, but is adapted for these smaller businesses. So it's a much shorter version. It's only about 250 pages, which is massively reduced from full international standards. It simplifies the accounting treatment. It's easier to apply, and a big benefit is it reduces disclosures. I think it's a great idea. I'm fully behind it. It's up to individual countries whether they want to adopt it. About 85 countries so far allow its use. one point to be aware of with regard to SMEs is when we say it's the IFRS for small and medium-sized entities, somewhat strangely, that's nothing to do with size. A small and medium-sized entity is an entity which is not publicly accountable, which simply means it's not listed and it's not something like a bank or insurer. So it's not a size issue. You can have some very large companies could actually use this standard. So let me quickly take you through the list of international accounting standards. But before I do that, I'll just make this point about why we have international accounting standards and why we have international financial reporting standards. International accounting standards were issued by the International Accounting Standards Committee. That was the body that preceded the International Accounting Standards Board. The International Accounting Standards Board came into being in 2001. And when it came into existence, it stated that any existing standards issued by the International Accounting Standards Committee would remain in place. They wouldn't get renamed or rebadged. They'd remain in place until they were replaced or amended by the International Accounting Standards Board. So these IAS are simply standards that were issued by the old body, but a number of them have since been amended by the International Accounting Standards Board. So IS1 is standard relevant to all companies, all entities, presentation of financial statements. This deals with the form and content of the primary financial statements, or most of the primary financial statements. So the statement of financial position or the balance sheet, the statement of financial performance, the statement of comprehensive income, the statement of changes in equity. It doesn't deal with cash flows. It just deals with those statements, so it's not purely all primary statements, it's just those specific ones. It also deals with disclosures. Some disclosures are also covered in that standard as well. IS2 deals with inventories or stock. IS7 deals with the statement of cash flows, the other primary statement. So this deals with form and content and disclosures associated with cash flow statements. IS8 deals with guidance for how companies develop accounting policies and how they should deal with changes in estimates and how they should deal with accounting errors. IS10 is a disclosure standard dealing with events after the end of the reporting period. IS12 deals with income tax, current tax and deferred tax. IS16 is a standard relevant to most entities, property, plant and equipment, what many people might refer to as tangible fixed assets. IS17 on leases, this is the standard that is being replaced from 2019. And IS19 on employee benefits covers the whole range of employee benefits. It covers accounting for wages and salaries, for bonuses, for pensions, for health benefits, and so on. IS20 is government grants. IS21, another important standard. What exchange rate should be used when a company carries out a transaction with an overseas business, when it should retranslate foreign exchange balances and when it shouldn't, and how it should deal with foreign subsidiaries and foreign associates to incorporate them into consolidated accounts. IS23, borrowing costs, whether we should capitalize or expense borrowing costs. IS24, a disclosure standard to do with related parties. Then some other standards, IS26, not that significant for most. 27 on separate financial statements if they're prepared. 28 on associates and joint ventures, and 29 on hyperinflationary economies. IS32, presentation of financial instruments, is really the should financial instruments be classified as debt or equity. Earnings per share, IS33, only applies to companies whose shares are quoted on a public market. IS34 is for those entities who are required or choose to do interim reporting. It's not a mandatory standard. 36 on impairment of both tangible and intangible assets. 37 provisions, 38 intangible assets. So IS16 is tangible assets, IS38 is intangibles. IS39 has essentially been replaced by IFRS 9, but the one element that remains is hedge accounting, because companies applying IFRS 9 from 2018 are actually allowed to continue using the hedge accounting requirements of IAS 39, which is why that's still there. So IAS 40 is investment property and 41 is agriculture. So in terms of IFRS, so IFRS are new standards or standards issued by the International Accounting Standards Board, issued therefore since 2001. So IFRS 1, I suppose what drove this was when the European Union was moving towards adoption of IFRS. Therefore, there was the feeling that we needed something specific to help companies make the transition to IFRS. So this is a standard that is used once on transition and then never used again, and it covers the process and disclosures. IFRS 2 on share-based payment, where that's used as a form of remuneration. IFRS 3 deals with acquisitions of subsidiaries. IFRS 4 insurance contracts, which is being replaced by IFRS 17 in due course. 5 is to do with non-current assets held for sale and discontinued operations. It's largely a presentation and disclosure issue. IFRS 6, very explicit, to deal with mineral resources. IFRS 7, a particularly challenging standard, particularly for financial service businesses. It's a challenging standard for other companies to get used to, but many of the disclosure requirements don't apply to those companies. But for banks, there's extensive disclosures. So it's a very challenging disclosure, it's not always complied with appropriately. And then IFRS 8 is again a standard which has a specific application to those entities where their debt or equity instruments are listed on a public market. Other companies can apply IFRS 8 by choice, but it's required only for listed companies. It's a disclosure standard. And what you'll notice, just pausing a little bit there, is that some of these standards are disclosures only. So IFRS 8 is disclosure only. IFRS 7, I mentioned IFRS 24 on related parties, and IAS 33 is disclosure only. Most standards also have their own disclosure requirements as well. So disclosures are all over the place. Some disclosure only, some are accounting treatment and disclosure standard. IFRS 9, this standard is coming into effect for the first time for periods commencing on or after 1st of January 2018. Parts of this standard have been out there, have been in issue since 2009, so it's been a long process to get to this point. So we're awaiting to see how companies actually cope with this. IFRS 10, 11 and 12 is all to do with sort of group accounts and investments. So 10 is to do with the preparation of consolidated accounts, 11 is to do with accounting for joint arrangements, and 12 came to being a couple of years ago. All of the disclosures to do with subsidiaries, associates and joint ventures are now moved to this one standard to make it more consistent and easy to actually use. IFRS 13, very important standard. About 50% of standards make reference to fair value, either as a possible measurement basis or perhaps as a disclosure issue as well. And for many years, the guidance on how to establish fair value was pretty mixed and disjointed. So a few years ago, the International Accounting Standards Board decided to bring it all together. So we have this one standard which sets out how entities should arrive at fair value, whether that be from a measurement perspective to include in the accounts, or whether it be to make disclosures. IFRS 14, a minor standard to do regulatory deferral accounts, is a temporary standard. And then IFRS 15, another one which comes into effect for the first time for periods commencing 1st of Jan 2018, is the revenue standard. And there's webinars coming up on both IFRS 15 and on IFRS 9 in the coming few months. So those are the standards that companies with December 2018 reporting dates have to be reflecting to the extent they're applicable in their financial statements. Just to mention two others which are in issue but not yet effective: leases. Replacing IAS 17 comes into effect in 2019, and IFRS 17 further afield to 2021. Got a question just picked up there. Where can we see IAS or IFRS effective for accounting periods commencing on or after the 1st of January 2017? The answer to the question is there isn't a straightforward list. If you have access to the IFRS Blue Book, the Blue Books, they publish one each year. And if you looked at the IFRS Blue Book for 2017, that only has the standards and interpretations effective for 2017. Otherwise, you've sort of got to work backwards in terms of looking at when these standards come into effect to try and then work out what they replace to actually see how it works. So I apologize, there's not an easy way to do that. It's just actually looking at the contents of the Blue Book. The 2017 Blue Book is the safest possible way to do that, or you might find access to it on one of the accounting firms' websites, but we don't sort of make things that easy for you. They don't make things that easy for you. Apologize. That's how you'd pretty much go about it. Just want to mention very briefly the conceptual framework. The conceptual framework is something that you'll hear reference to. It's not a standard, but it's the background to helping the IASB prepare standards. So it sets out concepts, it sets out principles that underlie the preparation. Primarily it deals with the objective of financial reporting. So the objective is to provide useful information to a wide range of users to make decisions. So this would be primarily for investors, potential investors, and creditors. So fairly straightforward objective. The qualitative characteristics of financial information. So to achieve that objective, financial information should be relevant and it should give faithful representation. So it should be accurate, complete, and free from error. What it also suggests is there are enhancing characteristics. So the fundamental characteristics are those, and the enhancing characteristics are comparability. As I mentioned, that's an important requirement when you've got companies based all around the world. Verifiability, which means that accounting treatments can be justified. Timeliness, that information can be produced on an appropriate timescale. And understandability, which I think is a challenging objective because, of course, if people can't understand it, then it's hardly going to be useful. And finally, the conceptual framework also covers the definition of assets, liabilities, equity, income and expenditure. It sets out when assets, liabilities, income and expenditure should be recognized, not too early, not too late, and sets out the measurement bases that might be able to use, whether it be fair value or historic cost. The purpose is primarily to help the IASB develop new standards. So the framework then feeds into their thinking. An example of this is the development of IFRS 16 on leases. In developing that standard, there was a recognition by the IASB that keeping leases off a lessee's balance sheet did not comply with the conceptual framework because a lease for the lessee satisfied the definition of an asset. So the development of IFRS 16 and the requirement now, or moving forward, to bring leases onto the lessee's balance sheet follows the conceptual framework. The conceptual framework also helps the IASB reduce the number of alternative accounting treatments. That's clearly going to help comparability to reduce choice, and it helps other national standard setting bodies. So if they haven't got their own statement of principles or conceptual framework, then they could have recourse to the IASB's conceptual framework. The concepts might help preparers. If there is no standard which deals with a specific issue, then preparers are advised to use the principles in the conceptual framework, the definitions of the prime components and so on to guide their thinking. It might help auditors reach their audit opinion. It might help users interpret the financial information. And overall, it then helps us to understand how the ISB's got to where it got to. So those are the standards that we've got in place. What's coming? I think if you look at the work plan of the ISB, you'll probably notice there aren't what you'd call some major new standards coming out in the very near future. The major new standards would have been things you've had recently, like leases and revenue and insurance and financial instruments. So having dealt with those, the ISB's work plan, which is based on the agenda consultation I mentioned earlier, the ISB's work plan is regularly updated. So they start off with one and then they update it. And when you look at the work plan, you can see that it reflects whether something's going to be or is a discussion paper, whether it's going to become an exposure draft, whether it's become a standard, and it identifies the timeline. If it's going through meetings and reflection, it'll highlight that. So you can follow through exactly where the project is up to. What I think the key projects are on the work plan at the moment are the conceptual framework is going to be updated sometime this year, a revised version picking up some revised definitions and so on. An important project, but probably not going to end this year, is looking at primary financial statements, whether we need to look at the form and content of particularly performance statements, the statement of profit or loss, the statement of comprehensive income. It might also be, it's been in their mind for a while as to whether we should actually combine IAS 7 and IAS 1 to have all the primary financial statements together. Disclosure has been a real issue, a real focus of the ISB for a few years now. In the last couple of years, we've had amendments to IAS 1 and IAS 7 under what has been called the Disclosure Initiative, which is trying to get entities to focus on making sure they have disclosed important information, but they're not disclosing irrelevant information. And that has had some impact, but the ISB is now thinking about developing some principles of disclosure to try and help this move forward. So it sort of links with transparency, and maybe we've gone too far in over disclosing. I'm just trying to get it back to providing information which is relevant. So a discussion paper was issued last year on the principles, and so we'll see that project evolving in the next few months. And then the other project is goodwill and impairment. It's a sensitive issue for many companies, and so the guidance will be looking at making sure that impairment of goodwill is recognised on an appropriate basis, the amounts are recognised, and on an appropriate timescale. Also potentially revisiting what's included within goodwill. For a number of years, we've been required to separate a lot of intangible assets out of goodwill, and so this is perhaps thinking that maybe some of them could be amalgamated with the total goodwill figure, and we wouldn't lose a major benefit. So those are the key projects, but if you have a look at the work plan, you can see the wide range of things that they are looking at. So my final reference is just where can you find out more? Clearly in this time we've had available, it's been an overview, but there's a lot more information you can find. And so just highlighting a few websites for you. Clearly a very important one would be the IFRS Foundation. If you visit that website, you'll find out more about the structure, what the different bodies do, the standard setting process. You'll find the work plan. You'll find access about what's happening on projects, and you can get information about the various news items when something significant happens and what sort of events are in operation as well. So it's a really, really good website to use as a resource. If you're interested in the EU endorsement process, then the EFRAG website, the European Financial Reporting Advisory Group, was one of the bodies involved. That's helpful. And of course, the large accounting firms have got information out there, which again It's just a personal preference as to which of the big firms you want to visit. I've highlighted one. There's a couple in the notes. IS Plus is Deloitte's, but there's great information out there that you can access, including in many cases sort of illustrative sets of accounts, which are always very useful. And then depending on your accounting body, there's probably information that you can access through the accounting body to support things as well. So I've highlighted my accounting body, the ICAW, but of course you've got ACCA and so on out there, which have also got great information available to you. So that brings us to the end of the webinar. Looks like I only have the one question, which I hope I've dealt with. I have an appreciation for that, as if I have done, so that's great. So I hope that's been useful. I hope it's given you the background that you wanted to with regards to international financial reporting, and given you a motivation to go and find out a little bit more, but also sets the scene for some of the upcoming webinars that we've got ahead of us. So thank you very much for listening.